The Depository Trust and Clearing Corporation, or DTCC, is preparing to launch a tokenization service in 2026, with limited production trades planned before a broader rollout later in the year. That sounds like tokenization finally breaking into traditional finance. But the more important detail is where the assets stay once the token exists. If the tokenized version is still anchored inside the Depository Trust Company, or DTC, then this is not just adoption. It is Wall Street testing a new digital operating layer without letting the asset fully leave the system. DTCC's tokenization service matters because DTCC is not sitting on the outside of U.S. markets. It is part of the infrastructure underneath them. This is not a startup trying to pull institutions into a new crypto rail. This is the existing market system testing how tokenization works inside the structure institutions already use. The first clue is what DTCC says the service is focused on. The service is built around DTC-custodied assets. In plain English, that means the tokenized version is tied to assets already sitting inside the traditional custody and record-keeping system. These are not free-floating tokens, with no connection to the old market structure. The confirmed scope also matters. The framework points to highly liquid assets like Russell 1000 equities, major index exchange-traded funds, or ETFs, and U.S. Treasuries. DTCC has discussed limited production trades in July 2026, followed by a broader launch target in October 2026. That does not mean the whole market flips on-chain overnight. It means tokenization is being prepared for controlled production inside the place where major securities already live. To understand why this is different, you have to understand what DTCC represents. Through DTC and related infrastructure, it sits near the center of clearing, custody, settlement support, corporate actions, and the back-office machinery that allows securities markets to function. That sounds dry, but it is the part that matters. When a security trades, the market does not only need a buyer and seller. It needs records, ownership rights, settlement rules, asset servicing, and systems that institutions can trust after the trade happens. DTCC's own framing says the service is designed for systemic scale, where deep liquidity already lives. That phrase is easy to skip past, but it tells you the direction of travel. The question is not only whether assets can be tokenized. The question is whether tokenized assets can operate where liquidity, ownership records, and institutional workflows are already concentrated. The next clue is mechanical. The token does not behave like a clean break from DTCC. It stays connected to the system that issued the entitlement in the first place. The detail that changes the story is not the word token. It is what the token remains connected to. The simplest way to picture it is this. The token is not the asset walking out of the vault. It is more like a digital receipt that can move through a controlled network, while the asset relationship still points back to the vault. That is not a perfect analogy, but it gets the main idea across. The token moves. The institutional custody link remains. In DTCC's model, a participant's claim to an eligible security can be moved from a traditional DTC account into a digital structure. Then, a token is created to represent that entitlement and delivered into a DTC-registered wallet. The token can move between approved wallets, but the underlying custody relationship still points back to DTC's system. DTCC also has a record-keeping layer, called ledger scan. That matters because institutional markets do not just need tokens that move. They need official records that can be reconciled, supervised, and trusted. So the asset is not being thrown into open DeFi and told to find liquidity on its own. It is being represented digitally inside a framework that institutions can control. At that point, the token starts to look less like an escape route and more like an interface DTCC can govern. The reason this model matters to institutions is that it tries to preserve what the market already needs while changing how the asset can operate. DTCC's materials point to tokenized versions carrying the same entitlements, ownership rights, and investor protections as the traditional assets they represent. Think about a tokenized ETF share. If it has the same CUSIP, which is the standard U.S. securities identifier from the Committee on Uniform Securities Identification Procedures. The same symbol, the same economic rights, and the same investor protections. Then the market can begin treating it as a different operating form of the same security rather than as an entirely separate instrument. That is a major difference. It reduces fragmentation. It gives institutions a way to test tokenization without telling the market that the old version and the tokenized version are completely disconnected. Nasdaq's tokenized securities framework reinforces that idea. The important point is not simply that tokenized shares can exist. It is that tokenized and traditional forms can be connected to the same underlying market identity when they carry the same rights and privileges. In plain English, tokenization may not show up first as some wild new crypto market. It may show up as familiar assets moving with new speed, new programmability, and new institutional controls behind the scenes. The smartest skeptic would say, this is still limited, permissioned, and controlled. That skeptic would be right. But that is exactly why the story matters. At launch, DTCC's tokenized structure does not appear to mean full open-chain settlement in the way many crypto investors imagine it. DTC participants can move DTC tokens between registered wallets outside normal market hours, but DTC is not processing the cash side of those movements. That is a major guardrail. There is another important limit. Tokenized securities are not expected to receive DTC collateral value or end-of-day settlement value at launch. If a participant wants to use the security in traditional DTC settlement, that tokenized claim has to be converted back into traditional book entry form. That may sound restrictive, but the restriction is the institutional logic. DTCC is testing tokenized representation, registered wallets, digital record keeping, and asset mobility while keeping the most sensitive settlement and collateral functions inside known controls. This is not a crypto free-for-all. It is a controlled bridge between the existing security system and a more programmable digital layer. The working group is one of the clearest signs that this is not just a technology experiment. DTCC has described collaboration with more than 50 firms across traditional finance and digital asset infrastructure, including major asset managers, banks, custodians, market makers, exchanges, crypto infrastructure firms, and back-office service providers. The names will get attention: BlackRock, J.P. Morgan, Goldman Sachs, Nasdaq, State Street, Franklin Templeton, Circle, Digital Asset, Ondo Finance, Ripple Prime, and others all bring different incentives into the same conversation. But the deeper signal is not any one logo. It is how many different parts of the market need to coordinate before tokenization becomes usable. A tokenized market does not work just because someone creates a token. It works when custody systems, trading venues, compliance teams, corporate action processes, liquidity providers, and back-office systems can all understand what that token represents. That is why the working group matters. Tokenization is not one function, it is a stack. And if the stack does not coordinate, the token itself does not become market infrastructure. DTCC's materials point toward a multi-network environment rather than a single-chain takeover. DTCC references AppChain and Canton and describes a model that can support multiple token standards, embedded compliance, and interoperability across different blockchain environments. AppChain matters because it is positioned as an enterprise-grade blockchain environment for institutional use. Canton matters because of privacy. Institutions generally cannot expose positions, counterparties, and transaction details to every participant on a shared ledger. Canton was designed so transaction visibility can be limited to the parties that need to see it. That is the institutional logic. Different systems solve different problems. One layer may handle token issuance, another may handle privacy, another may connect liquidity, execution, or settlement workflows around the asset. So this does not mean every asset will run through one chain or that one network has won. It means institutional tokenization is likely to look modular. The relevant question becomes whether each layer can do its job without breaking the rest of the system. Ripple Prime appears in DTCC's industry working group, and that is worth paying attention to. But it needs to be handled carefully. There is no basis for saying DTCC is using XRP, the XRP ledger, or Ripple's stablecoin in this service, unless a direct source confirms it. The relevance of Ripple Prime is not a token claim, it is a market structure claim. Prime brokerage is where institutions access execution, financing, liquidity, margin, and multi-asset workflows. If tokenized securities are going to become operational, the asset representation is only one part of the system. The market also needs professional access layers around it. That is the proper way to view Ripple Prime here. It is one participant in a broader institutional coordination layer. Its presence supports the idea that tokenization is not merely about putting securities on chain. It is about connecting tokenized securities to the professional systems institutions already used to trade, finance, hedge, and manage exposure. For Ripple and XRP viewers, that distinction matters. The signal is not that DTCC suddenly became an XRP story. The signal is that tokenized markets create more demand for the kinds of liquidity, custody, brokerage, and settlement layers Ripple has been building around. The most important takeaway from DTCC's tokenization service is not that the old system is surrendering to crypto. It is that the old system is learning how to absorb the parts of crypto that solve real operational problems. That is a quieter story, but it may be the more important one. Tokenization does not need to arrive as a revolution to matter. It can arrive as a new operating mode for securities that already have legal rights, custody arrangements, corporate actions, investor protections, and deep liquidity attached to them. In that world, the token is not the rebellion. The token is the interface. It gives existing financial infrastructure a way to become more programmable, more continuous, and more interoperable without throwing away the controls that regulated markets depend on. The final signal is control. Tokenization is not simply coming to finance as an outside force. Finance is beginning to define what tokenization is allowed to become inside the system it already runs. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.